September 2024 interim meeting on the Commission on Race and Access to Opportunity to order. Lead staff is Brandon White and committee assistant is Logan Schaff. I ask Logan to call the roll.
Senator Berg, Senator Neal, Senator Westerfield, Representative Brown,
Here.
Representative Heverin, Representative Kilcarney, Ms. Baird, Mr. Coleman, Mr. Davis, Mr. Pryor, Ms. Smith-Willis, Co-Chair Mays Bledsoe,
Here.
Co-Chair Timoney.
Here. We do have a quorum? All right, we do have a quorum, but before we do that, we had a new member join our commission last month, Ms. Smith-Willis, and it dawned on me today that we didn't give you an opportunity to introduce yourself and talk about your passion for being on the commission. So if you wouldn't mind taking a couple minutes and bring
Thank
us up to
you.
speed.
My name is Katima Smith-Willis. I'm from Frankfort, Kentucky, born and raised. I just wanted to get involved. I'm 27. I am active, willing, and ready. I have the energy. I'm from Frankfort, like I said. I am running for city commission currently. So my life is public and advocacy and speaking up for the people. So I'm here, I'm learning, I'm excited. If I look a little lost sometimes, it's just because I'm just taking it all in. This is a really great experience, and I'm really honored to be up here with you all. So thank you.
Thank you. Thank you for taking this on. This is important work. So, and you bring a lot of questions, and that's what's important. That's what's important. We do have a quorum, so at this point, if everyone's had an opportunity to review the minutes of the previous meeting, we need a motion for approval.
So moved.
We have a motion. Do we have a second?
Second.
Second. All in favor of approving the minutes? Do we do that? Say aye.
Aye.
Opposed? Motion to approve the minutes passed. We good, Logan? All right. We have an outstanding agenda today, one of probably the hottest topics outside of pets being eaten in Ohio is affordable housing. And we are really looking forward to hearing the committee today. And then also we're going to have a discussion on reentry. So at the table today, if you all wouldn't mind introducing yourselves, we're going to discuss affordable housing.
I'm Andy Johnson. I am the Chief Policy Officer for Commerce Lexington.
I'm Zach Worsham. I'm the Vice President at Winterwood Incorporated.
I'm Johan Graham. I'm the owner of AU Associates, an affordable housing developer in Lexington.
And I'm Daryl Neer, the CEO of Lexington Habitat.
Thank you for the introductions. Co-Chair Bledsoe?
Thank you, Co-Chair. I just wanted to take a minute and introduce a little bit about this project and why we're discussing it here today. If you're not familiar with Lexington and Fayette County, we have an urban service boundary that really limits where we do a lot of our development in the city, and we've had this for decades. It's one of the things that's a bright shining star in Fayette County is you can kind of drive within 10 minutes and be on a horse farm and drive downtown, and we love it. But there are some aches and pains that come with limited land use, and during the land conversation the last couple of years, it's become a very political one. And that's not always the best way and strategy to handle what really is a community issue. And so what we saw last year was a number of our private sector investments and stakeholders come together on their side and say, what can we really do together to make a difference in the community? And I was involved in that discussion, really on the sidelines, answering questions, giving feedback. But it really was a private sector investment and discussion. And out of that came what we've kind of referred to as this project in Lexington around Transylvania University. But really what we're here today is talk about the uniqueness of the discussion around the table, and then two, what are some lessons learned and best practices that might have statewide policy that we could consider moving forward. So I was thrilled with the level of investment by a number of people, stakeholders in this room, and I'm excited for them to share with you some of their lessons learned from the last year.
Thank you. Thank you, Senator Bledsoe, for the opportunity to share with the Commission about Lexington's transformational housing affordability partnership. Like I said, I'm the Chief Policy Officer, so I handle all the government relations work for Commerce Lexington. We are the Greater Lexington Chamber of Commerce. We represent more than 1,900 business members in Lexington and the region, and our mission is to increase jobs and workforce in the Lexington and our 9-county region. So through this project, Commerce Lexington, the business community, really served as the convener and the champion for this type of collaboration to address a critical challenge for Lexington, which is housing affordability and availability. In Fayette County, when talking with business community members, one of our greatest challenges is workforce attraction. And within workforce attraction, one of the key components is housing affordability and availability as a quality of life aspect. This is really particularly challenging for families that are in that 80% to 30% of AMI, of area medium income. And workforce housing is also a challenge in Fayette County, and we define that 80% to 120 of area median income. Finding a starter home in Fayette County, if you're a young professional, really is nearly impossible in today's environment. The median home prices in Lexington, have increased 100% in the last 10 years, whereas median wages have only increased 30%. According to Fayette County PVA David O'Neill, the median home price today in Lexington is around $310,000. So while housing is a national issue, land use development policies in Lexington, they really have impacted the market locally, limiting our supply, increasing land costs, and making it more difficult to provide enough of that supply to meet the community demand across the spectrum, but particularly when we're talking about affordable housing. The Kentucky Housing Corporation's recent housing report did note that Lexington has a nearly 22,000 deficit in terms of the number of housing units, both rental and home ownership, single-family homes that we need to meet community needs. So approximately 1 year ago, as Senator Bledsoe said, this partnership came into existence, and it was really at the insistence of the business community. Luther Deaton, chairman of Central Bank, Todd Johnson, who is the executive director of our Home Builders Association in Lexington, they were really the catalyst behind this. They understood that there was a need out there, and they asked the chamber to convene key leaders in banking, in affordable housing, in local government, to really talk about what was going on in Fayette County and how could we work together to address this problem with some solutions locally. So the local banks were really trying to figure out how they could be part of the solution, and specifically how they could leverage Federal Community Reinvestment Act credits for affordable housing. And the housing developers expressed and talked about some of the challenges that they had and the need for more inventory in the market. And based on those challenges, everybody around the table talked through what were the most appropriate solutions to have an immediate impact in Fayette County. And the result was that 5 of our local banks stepped up. This was Central Bank, Traditional Bank, Republic Bank, Community Trust Bank, and Stockyards Bank. And they committed to creating a capital fund to invest in affordable housing in the community, leveraging those CRA credits. And then the group started looking around Fayette County for property. And as you know, inside the urban service boundary, that's not easy. There's not a lot of vacant parcels, particularly of a significant size, to access. But luckily, last fall, Transylvania University was interested in selling their baseball field, which many people think is downtown, but it's actually out South Broadway, close to the I-75 exit. And they were willing to be and wanted to be a partner in this type of effort. So the 5 local banks did purchase 12.5 acres, which is really unheard of within Lexington's urban service boundary, for $2.8 million. And they're currently working with 5 local affordable housing developers on a master plan for both rental and home ownership opportunities on the property. We should also say that Mayor Linda Gorton and the City of Lexington have been at the table and are very supportive of this collaboration. And during last session, the General Assembly allocated $10 million for infrastructure to get this project going quickly as a pilot project of how a partnership can work locally. And so we're really appreciative of Senator Bledsoe for her leadership on that investment. I have to say, too, we took the group to Washington, D.C. in May to talk with the U.S. HUD Secretary about this project as well. And, to have this many partner groups working together really is unique and innovative. And the Secretary also said that she felt like, from what she's seen across the country, that this level of collaboration from local government, banks, state government, housing developers was truly unprecedented and something to look at trying to replicate. So yesterday, the Housing Task Force heard from the Kentucky Chamber and the Kentucky Home Builders Association about housing needs. And some of those policy recommendations included additional infrastructure support for housing, regulatory, zoning, and development process reforms, in addition to really supporting these local and regional collaborations. And these are things that we support too. But our goal today is to share with you an example of a local partnership to address a housing challenge and to really talk through some of the state policy ideas that may provide some additional tools to try to replicate this affordable housing model throughout Kentucky. So unfortunately, our banking partners were not able to be here today due to a national banking conference, but we are providing feedback on some of their ideas for solutions through the presentation. So again, we appreciate this opportunity, and now I'm going to turn it over to the experts in this, our affordable housing developer partners, to talk with you all more specifically about each aspect of the project and to talk through some solutions from their perspective. Zach, I'll turn it over to you.
Thank you, Andy, and thank you, Co-Chair Bledsoe and Timoney and the rest of the committee for allowing us the opportunity to share with you today a little bit about what we've been able to do together in Lexington. I think it's no secret to anyone in this room that we have an affordable housing crisis in this Commonwealth. Andy mentioned a report that was recently commissioned by the Kentucky Housing Corporation, which estimates that right now we have a shortage of 200,000 homes in the state of Kentucky, and in 2029 we will have a shortage of over 280,000 homes. It's my firm belief that access to opportunity for Kentuckians starts with an affordable and safe place to live. And to address this issue, it's going to take creativity, collaboration, community engagement, and political will. And what you're going to hear from myself and my colleagues today is a little bit about how those four things came together to make this project happen, and some specific policy recommendations to make this kind of partnership replicable throughout our state. So with that, I'll turn it over to Johan Graham.
Good afternoon. So first I want to talk a little bit about the five main partners from the private sector affordable housing in this deal. The five main groups of affordable housing providers in Lexington came together. That would be Mr. P.G. Peoples with the Urban League, Mr. Austin Sims with the Lexington Housing Authority, Mr. Worsham with Winterwood, myself with AU Associates, and Mr. Nair with Habitat for Humanity. Those five groups are the largest five affordable housing developers of both single-family and multifamily rental and home ownership in Fayette County and in the Lexington region. We often compete for resources, compete for land, compete for small projects, compete for financing. But through this process with working with Commerce Lexington and the business leaders, we came to the realization that maybe to do something transformative, we had to work together, both on a policy perspective and on a capital financial transaction stack. So we've been working together for the last year. We've known each other for many, many years, but often, we worked side by side in the affordable housing industry, but have never worked together on a single project. And we felt like that was the best way to have a transformative project, was to really put our egos aside and focus on the affordability and a transformative power of that we could have for Lexington. Probably have the best options to pursue projects that were near and dear to our heart as well. So when we got together with the business leaders in Lexington and the bankers, we came up, over the course of several meetings, we came up with three core ideas that were causing us all problems in the marketplace. One, access to land. Just the availability of land for multifamily housing, for single-family housing, for access to habitat homes is a huge problem. Two, high development costs for affordable housing and for market rate housing too, just the cost of development. And especially when you develop those projects on a very small scale, the marginal costs of those are not very efficient. So could we find a way to do a scaled project that made a little bit more sense financially? And three, even though we're the five biggest affordable housing developers in Lexington, none of us have the capital and the runway to really look out 2 and 3 years in advance to hold land, to develop property, to think about the right master plan for projects. We just can't compete with the market rate developers on that kind of timeline and scale. So it became really important for us to discuss how do we effectively buy and hold property in an environment where we're at a competitive disadvantage. It's hard enough to do for the market rate developers, but for the affordable housing community, it's really hard to go out there and go, oh, I see 5 acres of land over there. I can put $2 million down on that and hold it until we have a plan to build 5 homes, or if we have a plan to build 25 rental homes. It's just doesn't work that way. So we are at a competitive disadvantage. So what we worked together to, after we've identified those 3 main issues, we worked with the banks to establish this capital revolving loan fund. And they really came to the table with some inventive solutions that both helped this larger project that we're working on and I think are replicatable throughout the state. And how they've done that is basically the 5 banks who were the spearhead of this project put together a $3 million capital fund, basically investing in affordable housing in our community. They purchased the land. They were able to take what they call Community Reinvestment Act credits on that land. So through the federal government, they get official affordable housing credit for that property. We put a deed restriction to 80% of the area median income on that property. And they were able to call that officially an affordable housing project. What that helped us do is, okay, we got site control, we have ownership of property, and to top it all off, they're going to hold that property interest-free while we spend the time to develop it properly with good infrastructure, with long-term planning, maximizing the use of that property, maximizing the benefit for our citizens. So usually, once you buy property, the interest clock starts ticking. $10,000 a month, $20,000 a month. For any one of us, those costs are really difficult to handle. So the banks purchasing that property with the revolving fund and holding it interest-free allows it to be more creative and more productive as a group. Also, what that does is when this project comes to completion, we're going to talk a little more about the specifics of the project momentarily. When that project comes back to completion, that money goes back into the fund. We're all purchasing our individual pieces of this master plan property. And when that money goes back into the fund, it can be redeployed into our community. So that revolving loan fund is a catalyst for our community that creates opportunity for affordable housing of all types that we have not had before. And that is certainly something we're looking for on a state level basis with some of our banking partners. How can we develop this into other communities? How can we develop this on a more statewide basis? At this point, I'm going to turn it over to Zach to talk more about the project and some legislative goals.
Yeah, thank you, Johan. Just to speak briefly about the specifics of this project in Fayette County, what the decision of our banking community that Johan has laid out to hold this land for us has allowed us to thoughtfully master plan a site that will result in over 200 homes affordable to folks anywhere from 30 to 80% of the area median income. Some of those for home ownership opportunities and some of those for affordable rental opportunities for both seniors and for families. To talk a little bit about really an important piece to our bankers is how are we going to pay them back and how are we going to pay for this project? And these partnerships are often complex financial structures, which adds to the need that Johan has addressed for the time it takes to put these projects together and the benefit that it is to us to have banks hold this land interest free so we can do that. This is going to be a $53 plus or minus $1 million project, including all the housing types we've mentioned and the infrastructure for the site. And if we could go to the specifics, just to talk a little bit about what that's going to involve, $24 million of this will be private investment through equity and debt. And I want to talk a little bit about the equity for that piece because I'll get to a policy-specific recommendation later that this plays into. One of the most powerful tools in the affordable housing space that we have is the low-income housing tax credit, a program started in 1986 under the Reagan administration that allows affordable housing developers to sell tax incentives to private companies in exchange for non-repayable equity, which allows us to borrow less money. And when we borrow less money, we can cap our rents so that we can remain affordable in the long term. So that's a huge piece of this $24 million, $9 million in mortgages and private donations towards single-family home ownership, $5 million of commitment from the city of Lexington $5 million in additional commitments through the Kentucky Housing Corporation, and something that we're all here to, I think, say thank you for to this legislature is the $10 million in state funding that was allocated to this project through the budget process in this last session. That was pivotal for a few reasons. Obviously, it perfects our capital stack in a way that we can get this project moving, but it also does so quickly and allows us to get homes out of the ground within hopefully the next 12 to 24 months and repay our banking partners so that this fund can be used again in our community and hopefully in other communities throughout the Commonwealth. Now, I mentioned the low-income housing tax credit. There's thank you, Andy. There's a program that many states around us, and I think 30 states throughout the country have enacted to mirror that federal low-income housing tax credit program as a state low-income housing tax credit. And for this specific project, the equity, if Kentucky had a state tax credit that mirrors some of our neighboring states, the equity that the affordable multifamily housing developers would have been able to generate towards these projects would have been close to $8 million, almost releasing us from the need for the $10 million investment from the state. This is a program that is a pay-for-performance program. The benefit does not flow from the state to the investors until the project is built and leased to qualified low-income residents residing in this property. This tool will allow us to continue to give our banking community comfort to use these funds to pull down land on our behalf, because it's another tool in our tool chest that we know will get us to a financing plan more quickly. This is a pivotal tool that our neighbors have enacted, and there's been significant increase in housing production when this tool has been used in other states. And again, we would suggest that it mirrors the federal program in a way that allows us to sell tax incentives to investors who have state tax liability here in Kentucky and to hold properties at affordable rates for 30 plus years. So with that, I want to turn it over to Daryl Neer from Lexington Habitat for Humanity to talk a little bit about their involvement in this project and some policy suggestions that will help single-family home ownership in our state. Thank you.
Thank you, Zach. Thank you, Zach. I do want to thank the committee for the opportunity to speak today. And for Habitat for Humanity, we have, our brand is strong, but our focus is on home ownership. Unlike in the multifamily area, Habitat and single-family development doesn't have the same access to tax credits for our work. We do have access to HUD and home funds, and we do work with Federal Home Loan Bank, and certainly we work with KHC through the Affordable Housing Trust Fund. But most of our money is also coming through private donations to be able to make our work possible. And I also just wanted to highlight for a moment, because we are talking about race and access to opportunity. Habitat for Humanity has made a priority for Black home ownership. If you take a look at the statistics, we are at a 30% gap between Black home ownership and white home ownership. That percentage of ownership is at 44%, which is below where our numbers were in 1980. That gives you a sharp contrast in a focus on our crisis that we have in this country. And so how do we look at this and talk about increasing access to homeownership for all? And here are some of the biggest barriers when we talk about barriers to homeownership for communities of color. We can talk about housing discrimination, and certainly we have seen in the news recently about appraisals that come back well below what a white neighbor might have. You have the understanding information about the home buying process, because navigating for anyone for the first time going through the home buying process is confusing and can be difficult, and finding and being having access to that understanding. Access to credit. Right now for us, we are working with third-party lenders to be able to work with our homeowners to purchase their homes, but not all homeowners are able to qualify. And so certainly being able to make sure that we have those lending opportunities in place. And one of the spaces that banks have been good about and really strong about is making sure that they have down payment assistance programs for families in need. and we need more of those dollars available. But one piece you can't fix, you can have all of these other pieces in place, but that rising home prices and lack of inventory are squeezing us. In Lexington and Fayette County, when we go out, I mean, we are buying lot by lot. And right now, our lot prices that we are paying are $55,000 to $60,000 per lot. Go back to about 2019, 2018, we were in that $20,000 to $30,000 range. So all of a sudden, our cost of development has increased. Our cost of construction has increased as well. And so what we're doing is we're sniping lots, and we are good at building at odd-shaped lots. The idea of being able to develop on a 35-foot wide lot is a challenge for many, not for us. So the idea that being able to work on a 12.5-acre parcel to be able to build and deliver affordable home ownership opportunities is a blessing. And being able to work alongside the Housing Authority and Austin Sims and with the Urban League with PG Peoples to think about how do we collaborate to bring more housing into the marketplace. And for us, and we talk about the challenges in Lexington, I just want to, this isn't just a Lexington problem. Take a look at the KHC gap study that came out. Also, and I must emphasize, the Kentucky Chamber study aligns strongly with what the KHC study is laying out. And also as far as the recommendations. What we have is a situation, if people can't live in Lexington that have lived there for their lifetime, where do they go? Where do they go? They'll go to a neighboring county. What happens when we see those populations increase? We see housing. It is a perpetual problem, and as long as we kick the can on this issue, we are only going to see it get worse, and that is our challenge. There are some additional data that I could share with you. There's one piece that I would like to be able to highlight, and it's talking about the housing crisis that we have here in the state of Kentucky and the number of individuals who are in a situation where they are severely cost burdened. In Fayette County, that number sits for homeowners and for renters. Homeowners, 6% of our residents are paying more than 50% of their income for housing. 24% of our renters are paying more than 50% of their income on housing. Those are some of the additional pressures. And that's why this conversation becomes so important, because think about the impact, the transformational impact that stable housing has had on your lives, right? If you are moving from apartment to apartment, home to home, because you are evicted, you can't pay your rent, you need to move out of the community, what is the impact on the educational outcome for your children? If you are living in a rental apartment that is priced at $600 or $700 in Fayette County versus one that is market rate at $1,300, will it be as high quality? Will it have health impacts on your family? We talk about those as the powerful parts of the transformation here as well. So when we talk about house and also job stability for the homeowner, the ability to be able to know I'm not going to be displaced, I have a great place to live, and what about the economic advancement that those homeowners and individuals have because of a safe, stable place to live. So we are not just talking about units. We are talking about individual impacts that have generational change possibilities. And that's why investment in housing is so important for our Commonwealth. We can talk about a number of the ways that we can invest. And there's some low-hanging fruit. The Affordable Housing Trust Fund and Rural Housing Trust Fund are amazing tools, and particularly for habitat throughout the state of Kentucky. But if you take a look at the recent cash flows into our Affordable Housing Trust Fund, we are on pace to receive, and KHC is on pace to receive below $4 million this year. And part of that is a function of we don't have as many. One is the fee, $6 for a real estate transaction, and that's been the same for years. So that flat fee is part of the problem. But also, when you have no building going on, you don't have documents that are being processed. So we are seeing that instability in the funding mechanism. And this is something that the Kentucky Chamber of Commerce has come out and supported and said, we need to transform that funding mechanism and increase that funding mechanism to be able to support. And this is me editorializing here, right now we are able to use affordable housing trust fund dollars at 50% for families at 50% of income and below. Given the housing crisis that we are seeing across the state of Kentucky, we know people at 80% of income are having a hard time finding a place to live. So even increasing that percentage through statute will benefit and be able to deploy and help more homeowners throughout the Commonwealth of Kentucky. Now, there's some others. There are housing homeownership focused tax credits. I would just highlight a couple. One, Indiana has put a really strong program in place that is around for home ownership. It is a tax credit that goes to deduction on your income tax. I would put that out there as a point of reference to look at, and goes to affordable home ownership developers to help them do their work, like us. But also, you have tax credits that are expanded beyond that. Ohio has one that focuses around the sort of the workforce area as well. So, like, how can you and again, you're talking about mobilizing private capital to be able to help with solving this problem without putting additional state funds at risk, right? You're leveraging those dollars. And there's another piece that I would just emphasize. Wendy Smith from KHC did a great presentation at the Kentucky Affordable Housing Conference, showing what other states are doing to address their housing crises. And these are the three pieces that I would emphasize. They're bold, they're collaborative, and they are comprehensive, right? We're talking about mobilizing, in some situations, $500 million to address this issue, right? And it's not just going into one area, home ownership, or it is looking and saying, here is what the housing continuum looks like. And if we don't take a focus and look at the front end where people who are unhoused and needing stability, helping in that rental area, and also in home ownership, and not just affordable home ownership. How do we mobilize? Because right now, Habitat can't scale to solve this problem. Our for-profit developers can help, but how do we empower them to scale as well? Because that is also part of the challenge. How do we address this across that housing market, not just continuum, but the housing market as a whole? And so what I will do for the committee, rather than go through those, I want to provide Ms. Smith's presentation to you so you can have that as a point of reference and some of the really great work that is going around this country. So we don't have to reinvent it. We can take from other states and use what's working for us here in Kentucky. I do want to provide you some state policy recommendations just in general and some of the comments that have come out of the banks. And we talk about collaboration. And we talk about revolving funds. So, for example, Indiana just put together an infrastructure fund that would be a loan fund at a low interest to developers to build out infrastructure. That's really, in many ways, what's happening here. But how could the state and work with the banking association to be able to create something really powerful? And this is where we're like, how do we support local banks and regulators to recognize the CRA credits for affordable housing projects through collaborative investment funds? Because I think that has a lot of power. Renewing investment in new market tax credit programs to help banks deploy capital to the housing projects, and extending the time period for historic tax credit programs to allow for project completion. And then creating a new Kentucky low-income housing tax credit to increase access to housing capital for our developers. I mean, 30 other states around the country are doing so. Our neighbors are doing so and doing so powerfully. And being able to provide that mirror to our federal low-income housing tax credit is of particular value. Increasing investment to the Kentucky Affordable Housing Trust Fund, Rural Housing Trust Fund. We have that vehicle. And from somebody who utilizes that fund, KHC provides us immense flexibility in the use of those dollars. That flexibility is invaluable to us as a nonprofit developer. And so please, I would encourage you to increase that investment to KHC's in the Affordable Housing Trust Fund. Expanding access to state housing funds for workforce housing projects, and consider a tax credit program to support contributions to affordable housing organizations. I do want to mention one particular piece of legislation that is at the federal level It is the Neighborhood Home Investment Act. Andy is sick of me saying this. It has been sitting there for the last, I think, 3 or 4 years, right? And it's finally getting bipartisan support. Senator Young in Indiana is supporting it, and a senator from Maryland. So it's getting some legs, but it provides an interesting model to borrow from for the deployment for a tax credit model for single-family home ownership. So again, I am grateful for the opportunity that you all have provided us today to speak with you. And at this point, I'll turn it back to Zach.
Well, again, thank you to this committee for your time. I think we can all agree, and some of the statistics that have been thrown around here support this, that we have a housing problem here. And I hope you've seen today that our community in Fayette County, with the leadership of Senator Bledsoe and Representative Timoney, we are solution-based. We're looking for solutions to this problem. We want to find solutions that are replicable throughout our entire Commonwealth. So again, we've proposed some of those here and told you a little bit about this project, and we greatly appreciate the time to be with you today. I guess we'll answer any questions that the committee has.
Thank you all. That was very, very informative and really, really impactful information. Senator Berg, you're up first.
Thank you, and thank you for the presentation. Thank you for all the information. It's been very, very interesting. And I know I'm asking the wrong people here. You know, you all are the other side, but what would happen if we required market rate developers to commit a certain percentage of their developments for low income residents? And the reason this sounds attractive to me is because we know historically, when you take a place like this, 12.4 acres, and you put a whole development, those children, when they go to school, their classmates know exactly where they live. It isolates them and puts them as targets really from young ages. And we have found that it is better for low-income families to be not like put into a community of their own where they exist, but to be actually interspersed throughout the community. Which, if we required developers 3%, 5%, I don't know what the number is. I mean, we could figure out the number, looking at the need and looking at the number of developments. What's the problem with that? Why aren't we doing that?
Senator Berg, thank you for that question. And if I could, I am going to, for the benefit of my colleagues, say that I'm going to speak from my own opinion, and others may disagree with me. I don't feel that process, which has happened in other places around the country, has worked well. And from my perspective, one specific reason. One, the nuance of renting or selling a home to someone who has to income qualify is much more complicated than it may seem on its face. And there are people in this industry, in the real estate industry, who are experts in operating facilities that qualify income of the folks that want to own a home or rent a home from them. And I think we certainly set ourselves up for that not being done well by people in the marketplace who don't do it as a mainstay of their organization. And two, I think you will see an erosion of the funding opportunities that affordable housing developers have in their tool belt, which is already small. If you start to allow market rate developers, to require market rate developers to do a small percentage of their units, they are going to be eligible for things like Lexington's Affordable Housing Trust Fund. They're going to start using it, and you'll see a 200-unit apartment complex that has 10 units of affordable multifamily housing taking the same amount of money as a 50-unit affordable housing complex, because we have other tools that we can leverage with those resources, other federal programs, tax incentives. I think you're going to see a little bit of a cannibalization of the tools that we have, which are limited now under that. And to speak a little bit to what this particular development looks like for the income restrictions across it as a whole. I think what we've done here is done this in a way that is going to allow for multiple income types to live on one property. People making a wide array of incomes and in a couple of different housing types, home ownership opportunities for attached townhomes, then affordable rental communities, which may serve slightly lower income individuals. And what we hope to see is upward mobility come out of this site. People who may rent an apartment at this development may choose later to purchase a home in the same development, may choose to purchase a home somewhere else in that neighborhood or in our city. So I would say that we don't feel that this is a stigma creating partnership. We feel that this is a partnership that is really well thought out and will serve a lot of different types of folks. And I would just caution against the requirement to make market rate developers designate some of their units affordable. If my colleagues disagree, they feel free to.
I'll add a little bit to that. It's strange. This kind of hits in my bailiwick. I was an urban anthropology major as an undergraduate, and a lot of my studies focused on informal housing relationships in the low-income communities that they establish. And while I agree that the kind of inclusionary zoning, I mean, I'm really supportive of a lot of that literature, I think it misses the mark on two things that I think are really important to discuss. One, legislatively and community-based wise, community zoning, city council, those are really difficult policies to implement in terms of popularity. So even though they may be effective, it's just the barriers are really high. And oftentimes, I'm looking for policies that I can act upon quicker. Stuff like the state tax credit has a pretty distinct ROI on investment that's easier for legislators to oftentimes understand. So policy on the inclusionary zoning wide is harder to understand, I think, for a lot of people, and it makes it more difficult to implement locally. Second part of that is I think it underestimates the number of informal housing relationships there are in low-income communities, whether that be neighbors taking care of children. And so when you start dispersing people with limited means into more and more places, they lose access to their informal support. And that's kind of it's intuitive that way, that, that makes sense. They've lost their neighbors who usually provide childcare because they can't afford a regular daycare. They've lost a lot of their individual transportation needs because they've been put in a neighborhood that doesn't have public transportation, even though it's a higher end neighborhood. I think sometimes inclusionary zoning misses a lot of those informal living practices that people have in their communities. So it breaks up communities who have depended upon each other in a way that's not measurable. It is measurable, but it's not as apparent as it is when you're looking at it from an inclusionary zoning perspective. So I think a lot of the literature on inclusionary zoning is really interesting, and actually I personally support some of it. I do think it misses the mark on some of the informal housing solutions that a lot of people have adapted to in their local markets.
I would just make one comment on the home ownership side. I think that trying to find ways to incentivize affordable housing development within market rate communities is a powerful way to approach it, right? And so Lexington has just passed the zoning ordinance text amendment that will allow for additional density if you are providing affordable housing opportunities within your development. And we actually in Habitat can benefit from that. For example, there are situations where we could purchase a single family lot that would traditionally only have one home on and build a duplex, right? And because of that, it is a mechanism to be able to help incentivize. One of the challenges, however, is the cost of housing for for-profit developers has increased so much, even sometimes those incentives aren't incentives enough, right? And so there becomes that barrier. And there's also, I've seen it inclusionary zoning implemented in a variety of ways, but oftentimes it will have an opportunity to buy out of your requirement. And in situations, oftentimes you'll see that the amount that the buyout that is provided does not really have the impactful economic impact on the housing market, affordable housing market, as one would want. So to everyone's point, it is very challenging to measure this and making sure and finding the ways to impact. But if we can find ways that can incentivize the market developers to be able to do that work, I think that that's a more powerful opportunity.
I did want to add one more thing. I think we're learning as we work together that we're starting to have these same conversations that the five of us have had with the affordable housing community, with the greater market rate housing community as well, to kind of do this on a more informal but market-based approach, so that when we expand into new areas of town and there is requirement for affordable housing from the planning commissions or the city council, that maybe we can work together to do this. So maybe we can do what we're good at. If they can spare 4 acres in their 800-acre development or 400-acre development, can we work together to produce the affordable housing and they produce the market rate housing? Can we work together without legislative barriers on ways to produce more affordable housing and allow them space for us to do that? You know, so we can. It's a form of inclusionary zoning, but it's much more informal.
To add to this also, I think that one of the upsides to this is when you do a project that's this large a scale. I think scale is an important conversation here, because the 3%, if you're doing home by home spread out all over, you're talking about like a major impact to a community, and that's really you're taking advantage of cost, you're taking advantage of resources, infrastructure, you're taking advantage of everything when you do it on a larger scale. I worked in a middle school in Lexington that will actually feed the people that live in this complex will feed into the middle school that I worked in. And, Habitat has a huge number of homes in that area. And I'll be honest, Senator, I never heard any of the students talk about, well, you live in a Habitat home. Well, I think for a couple of reasons. First, because they're built so well. And there's so much pride in those communities that it's you take care of yours and you're keeping an eye on the neighbors. So that was something that's really impactful. So I don't think there's that necessarily that stereotypical kind of peer pressure per se, like it had been. But I think it's definitely the scale for me about this project is what's most important. It's most impactful. Senator Neal.
Thank you, Mr. Chairman. Can you hear me? Yes, sir. I was going to ask a question about the efficacy of this approach, but I think the gentleman on your right sort of led me to it in terms of the report and information you're going to provide, in terms of what's happening in other states and the studies that are associated with that. So I think I'll hold up on that. But this last discussion, Mr. Chairman, if I may, is rather interesting. What popped in my mind, it is a difficult proposition, just from my observation as well. But if you don't purposefully and intentionally collaborate, use the word collaboration, to address this issue, does it not contribute to the concentration of poverty, which is part, in terms of housing, which is part of the problem you find in urban areas now anyway? Anybody?
Yes is the answer. I think from the housing tax credit perspective, there was a case in Texas that went to the Supreme Court about 6 years ago that involved the Housing Finance Agency kind of steering projects toward more low-income areas. So the housing tax credit program, since that Supreme Court decision, has basically, one of the mandates from the Supreme Court was that affordable rental housing allocated through the Kentucky Housing Corporation programs had to be dispersed in an economically neutral way, so that projects weren't always ending up in the same neighborhoods, that we were building affordable housing in both the richest neighborhoods and in the neighborhoods that were supported by the infrastructure. So I think over the last 5 to 7 years, if you've watched the award lists from Kentucky Housing Corporation where projects are being funded, you'll find them in more diverse areas than they were before. So I think it's one of the positive impacts from that Supreme Court decision. I know in Lexington, we're having projects that are, if you're familiar with Lexington and New Circle Road, we're having projects transition from the north side around to the south side. We have our first project proposed in Council District 10, which is in the Palomar side, a senior housing project. We've had the first project in Council District 11, I think it was this year, that we're doing next to the Wellington Dog Park and Fayette Mall. So that is helping the criteria for funding for some of these resources is helping geographically disperse the housing tax credit projects, which I think was the intention of the Supreme Court case in trying to equalize and normalize where affordable housing is built. Now, is it always possible to build in areas of high economic opportunity? Not always. In this case, it's a little bit of a supply game. So one could argue that the production of affordable housing everywhere, in every council district, and every legislative district is a priority. No matter where it's at, we're so far behind in the supply curve that we just need to build it. So that's the kind of the yes, but answer to what your question was.
Mr. Chairman, thank you for that answer. I appreciate that. And I appreciate these efforts to incentivize investment and overcoming the current hurdles that you're dealing with, rising cost and those kinds of things, lack of inventory. I'm just trying to think, because I'm looking at what's happening in my community right now, and I find even though these efforts are being made and I see structures being built in different places, there's a lot of pushback from various other communities, whether they are low-income communities or higher-income communities. And I'm just wondering if there's been sufficient planning, collaboration perhaps with planning agencies in terms of what spaces are more conducive, as how to enter those places, as opposed to getting the things processed and all of a sudden something gets torn down, something gets built. This collaboration piece interests me quite a bit.
The collaboration has been critical for the success here. And just to put this into context, I don't think anyone's talked about how the timing of how this project has taken off. In August of 2023, the group of partners got together to have the conversation. In January of 2024, we were announcing the acquisition of the property. In May of 2024, the legislature allocated $10 million for this project. And then this summer, we were sitting in the interim secretary Todman's office at HUD and walking her through that timeline, and she was blown away. She thought it was unheard of. You think about the competition that goes on among housing partners for funding. You think about banks are inherently competitive for market. That got set aside in these conversations and made that speed for the process for this to come about, because there was a lot of trust in the room. If there's a lot of trust in the room with a clear focus, it is amazing what could be possible, and I think we are a testament to that.
Thank you very much. Appreciate it.
Representative Kilcarney.
Thank you, Mr. Chair, Co-Chair, and thank you to the co-chairs, both of you, for having us, getting a lot of information on the affordable housing and just the housing issue and the housing crisis in general. Senator Neal, Senator Berg, and myself represent portions of Louisville, and so Jefferson County has been dealing with its own crisis for some time now when it comes to stock, when it comes to individuals not being able to find even transitional level housing coming off the streets. And so it is a crisis that is affecting all of us, not just urban areas, but it's now impacting rural areas. And one of the things I think we can all agree is that the pandemic has shown this is happening to everybody. It has now been highlighted, I think, given this conversation and conversations that we're having all across the state, that we need more stock of affordable housing. We need different kinds of housing. We need different ways to build the housing that we are planning on building. I had a couple of comments and then a few questions, if you don't mind. I'll try to keep it brief.
Very brief.
I know we have
just for you. Everybody else can go long, but you can go.
I will condense it as much as I can.
Thank you.
So I had, I know you had mentioned the increasing the investment in the Affordable Housing Trust Fund. Those are conversations that we've been having. I know that we should probably expect some legislation to increase that transaction number. And so I do agree that's kind of low-hanging fruit in terms of state-level mechanisms. I think another thing that's come out of all of these conversations that we've had is that the state is going to have to step in and support these efforts wherever they are and in whatever shape or form, whatever innovation you all have come up with and collaborations that we're seeking to fix this issue. Because it's only going to get worse in the coming years. So we need to be able to have pipelines and infrastructure in place. So that is something I hope that you all will be participating in when we have those discussions. If you haven't already, we have a housing task force that is meeting regularly, and I know Wendy has been a part of all of those conversations as well. So I'm hopeful that at least one of those bullet points will make it into the next session. One of the things I did want to ask you about, again, given that we've all been dealing with this in Jefferson County, and there's different models that have been tried, there's different tax incentives, there's different credits, there's all kinds of collaborations, private, public, all different iterations of that. So I just want to understand kind of the scope and the timeline of this particular project. You all have put together $3 million to buy the actual land, right? And so it says here, though, it's going to cost $53 million to actually develop it with the single-family homes, the townhomes, and the multifamily units. So one of my questions is, where is the sustained funding going to come from to finish this project? How much? And I know, I'm so sorry, I'm forgetting your name, from Habitat. You mentioned that you all are buying sort of smaller lots, and this is kind of the biggest scale project that you all might have been involved in recent years. What is the capacity there? How many of these either large scale or small scale kind of areas are available in Fayette to fix this deficit or to try to mitigate this deficit of, I think it was 280,000 units somebody had mentioned? Because we're talking here about 26 units, 24 units. I mean, and it's a start. I'm not saying, but how much land is there? Because that was also mentioned. There's a lack of inventory. There's a lack of space. So my question is about the scope of it. How much land is available? What is the sustained funding for it? And then when it comes to, the developers and the banks that are involved in the initial pool, what is the timeline that you all are expecting for the return on investment? When are they going to start asking for their money back? And what are you going to do in terms of your long-term plan? I'm sorry, this is a sort of wandering. It's all getting at, I think you understand the same kind of question. What is the danger that in order to meet those kind of goals, the ROI, that the cost will be raised? Right, so whatever the area median income is for this particular property, what is the danger? And I think it was kind of alluded to by my colleagues that you won't just be restricted in terms of building for a certain income threshold or higher because you can't sustain it in terms of the leveraging that you're going to get in terms of finances.
So I'm going to try to take a few pieces of that, and I'll focus on the incomes being served and the sustainable funding for the multifamily side, and then I'll let Daryl from Habitat talk more about the home ownership opportunities for this particular project. So one of the things that has already happened with this site is it has been deed restricted to serve folks making 80% of the area median income or less, and that deed restriction is really important to support what the banking community has done here. One of the reasons this was an interesting thing to the bank outside of their support of our community and their recognition of this need and their hope to address it is that they need to be making investments that give them credit under the Community Reinvestment Act. So their regulators can see that they're making investments into the communities they're serving, particularly into low-income housing and business opportunities. And so that deed restriction was non-negotiable for everybody. And so I don't think there's a fear that as costs rise, this will start to serve different folks. I think that is baked in from the beginning and an important piece of that $3 million that's already been put together. On the multifamily side, the access to certain types of funding is not necessarily our challenge. It's the time it takes to pull that funding together and the market disadvantage that we have in competing for the land that is available. The federal low-income housing tax credit program that we've talked about a little bit is something that several of us have a lot of experience working with. It's a very powerful tool to building affordable multifamily housing. It's something that AU, Winterwood, the Urban League, the Housing Authority, and Lexington have all had experience with. That program does take time to access, and it does take time to capitalize. And so having this land held interest-free gives us the opportunity to go for that sustainable source of funding with the ample time that we need to do that. In addition, and thank you for opening up to this, a thing that will make this more sustainable is a state low-income housing tax credit counterpart. That will be something that will allow us to generate more equity, which is going to give our banking partners more comfort to do this again and again and again if they know that we have this other tool. Part of the comfort that they had to spend $3 million on this piece of land was they knew we had the experience working with these various programs to pull this off. If we have yet another tool to do that, that's very impactful. And again, to go back to the benefit of this state infrastructure money that the legislature allocated to this project, $10 million, that's allowing us to do it more quickly. But that's money that will go out the door before the project's built from the state. This state low-income housing tax credit, again, is a pay-for-performance program. The money is not actually allocated and the benefit not given to those investors until qualified low-income residents are living in these apartment homes. So I hope that answered some of the question, and I know that there's a single-family piece to be discussed.
On the single family side, Lexington Habitat serves families at 30% to 60% of AMI. That is our focus. That is our mission, and those are the families we serve. Our financial stack is different. We are certainly, and this is an opportunity for anybody who's watching. We do not give away homes. I mean, that is still the number one myth that we have to confront. We sell our homes at an affordable mortgage to the families and individuals that we work with. So our home buyers have a skin in the game, and so that is the foundation for our funding stack. And then we are utilizing Federal Home Loan Bank, who we have a long-time relationship with, that provides our opportunity to be able to add on top of that to cover our construction costs. It's KHC, it's LFUCG, and because of those funding relationships, certainly with over time, I mean, if you take a look, our subsidy has increased for what we're doing, and taking a look at how are we best stewards? And if you take a look at the different funding partners, they all provide us with a period of affordability that we must meet. So 10 years, for example, on some of these. So even having conversations about even longer term affordability, I think is important because our housing market has fundamentally changed. And I wanted to talk about, because we're talking about the individual sections about our housing market. Let's talk about pathways in our housing market. In part, if we're not addressing throughout the continuum, we will hit bottlenecks, right? And if we don't have starter homes, we are locking people into perpetual renting situations that doesn't provide them an opportunity for generational wealth building. And then we come into this, who provides those entry-level homes? Very few developers. Habitat is part of that, but we're also relying on subsidies to be able to make this work. And so we're really attentive to the evolution of what is happening in the housing market to ensure that people have the ability to go from a Habitat home into a larger home because of the stability that it provides. But we always have to keep an eye on the front end of that system to ensure that people who are unhoused find housing, and they find access to transitional housing, to rental housing, and into home ownership. My fear is that without really aggressively, and I use the word boldly, looking at the home ownership component, that we will lock people out of that wealth growth and opportunity that has been part of us as a nation for since our founding. So just wanted to talk about that piece.
Thank you, and thank you for your indulgence.
Always a pleasure. Representative Brown.
Thank you, Mr. Chair. Thank you for the presentation. It is deep and it's extensive. I think something that was used, that this whole thing is bold, collaborative, and extensive. And I want to put those words back to you. I think we need not forget The median price of home ownership in Fayette County is $310,000. $310,000. That majority of low-income people can only imagine or even dream of having a property like this and owning a piece of land. The thing that, well, let me go back. Let me back up. A couple of months ago, there was a big community presentation made to the neighbors in this area, and at that time there was no laid out plan for the single family dwellings, the townhomes, and the multifamily units. That was not given. My first question is, has there been a meeting with the community about this plan?
And Representative Brown, thank you for your leadership in our community in Fayette County, and thank you for having us here today as well. Yes, we have had continued discussions with the neighbors. I can say that there is a general plan still, that there's a split of multifamily and home ownership. That plan is still being worked through. We haven't even had our kickoff meeting with the Planning Commission yet. So there are still, a lot of things that are up in the air, including neighborhood input. We have hired Ed Holmes from EHI Consulting to help us through that process. He and PG Peoples, Mr. Peoples did want to express that he was sorry he couldn't be here today. They are continuing to have discussions with the neighborhood, and we will continue to have collaborative group meetings with the entire development team and the neighbors as the process goes through.
Mr. Chair.
Yes, sir.
The median cost of single-family dwellings in Fayette County, how is that being addressed in terms of the 26 single-family homes?
As a point of reference, our most recent appraisal for one of our Habitat homes came back at in excess of $240,000. We anticipate that we will see an appraisal hit $270,000 here shortly. And our property is usually 1,300 to 1,600 square feet, and Energy Star certified. And I will put our quality up against most builders out there today, and the quality that we put into the marketplace. And it bears out in what we're seeing in our appraisals. I don't think when you take a look at the footprints of our home, they will be then that 1,300 to 2,000 square foot range. It mirrors the needs of the families that we serve. And while they may appraise at a certain level at a market rate, when we sell those homes, our homeowners never pay more than 25% of their income for their mortgage payment. That is our commitment, right? We want to make sure that our homeowners not only have a safe, affordable place to live, but they also have income that they have to be able to use for living and for growing. And that is the protection that we put into the homeownership piece as well.
I think one part of this policy-wise is, if you look at the recent policy implementation in Minneapolis, it's getting a lot of traction lately about just build. And so policy-wise, they went all out upon trying to build as many houses as possible, different types of dwellings, different neighborhoods, different densities, kind of throughout part of the zoning regulations and handbook. And what they were able to produce housing-wise has brought down, in terms of inflationary costs, the cost of home ownership and the cost of rental housing in that MSA has been one of the slowest rising inflators in the country. Do I ever think that $310,000 number is going to go down? Probably not. But it's how slowly can we slow the growth? And maybe the only way to do that is to produce more units, to produce more supply in the marketplace, which may finally catch up with the demand and equalize prices a little bit. It's probably never coming down. Fayette County's land use landlocked, but even in most parts of our Commonwealth, those housing prices aren't coming down. It's, can we slow the growth? Can we slow the inflation of both home ownership and rental prices by building enough houses? And what they found, I think it was, it was Senator Neal, I think, who was talking about neighborhoods a little bit earlier. I think there is this tension and pull between the policy of how much we need to build, just the sheer amount that we're behind, in all parts of our Commonwealth versus quality of neighborhoods and neighborhood standards. I think there's got to be that push and pull with those things. And I think the communities that have been able to grapple with that in an honest way, like sometimes it just has to be, we need to produce. Like, I understand your concerns, but we need to produce. And sometimes this isn't the right place to produce that. I think the communities that have been open and upfront about talking about those issues and having a firm policy guideline about why we're doing this. We're doing this for the future. We're doing this to bring home prices, to slow the growth of those things, have been the most successful. So I think the more we talk about this as a legislative body, as, you know, homeownership and rental housing providers, the more we just lay out what could happen and what can happen, I think that's the way to tackle it potentially.
Mr. Chair, if I may.
Yes, sir.
The neighborhood was seriously concerned about something that you have in your plan, 24 townhomes and 150 multifamily units. That is of concern. And have they been brought into the conversation about this development plan, or the plan that you all are talking about putting in place?
Well, I'll start with the first part of that. We pledged, so some of this information to this committee is intentionally vague because we pledged not to unveil any plan to the public before we've talked to them about that plan. So we don't want to stand up here and say X number of units of rental, X number of units of multifamily, and not have discussed that with them first. So I think that's important to us. We're looking from a policy perspective on the takeaways we can take from a bigger planning perspective. So we don't want to say we're building X number of family multifamily versus senior multifamily, and then feel like we're disrespecting their opinions from and not have had that community meeting yet where we've unveiled our plan. So I do want to be a little sensitive about not putting the cart before the horse
I
in
appreciate
some of those
that.
conversations.
I appreciate that, and I think that on behalf of the folk that live in the Russell Cave Quarter, I needed to ask that question.
No, and that's perfectly fine. I think we've been transparent about our answer, and I think that's one of the reasons we didn't want to come up here and throw out an exact plan about what was going on. Okay. I do think it speaks to the larger conversation of what maybe should be going on in terms of housing production and how that is at odds sometimes with neighborhood groups. And that is a difficult, for affordable housing development, for home ownership, for rental, for market rate developers, that is a really difficult conversation to have. And I think the more honest and more open about it, we may not agree, but at least we can be transparent about it.
Okay. Let me, if I may, Mr. Chair, I know time is getting short. I just one more.
Final question.
Okay. I think that continued conversation about this proposed development and how it will meet the needs of the citizens in the Russell Cave, Paris Pike, North Broadway corridor is important to have, and to work out all those details and all those nuances and put all those things in place. I do thank you all for coming. Brandon, you have talked about, I just need to make this statement, Brandon has talked about how we can come out of this committee, out of this commission, with a piece of legislation, and this may be it. This may be it, that we will hash out legislation that will address this particular property and this neighborhood and the surrounding neighborhoods around this property. Because the thing is that we want to get it right, and we want to provide affordable housing and affordable housing opportunities for citizens in Fayette County who want to be there and citizens that want to move into Fayette County. Right now, it is restrictive, and we're pushing people out. So thank you all for the presentation. I think that we have to have additional conversations. Thank you very much. Thank you, Mr. Chairman.
Co-Chair Bledsoe.
Thank you, Co-Chair, and thank you, Representative Brown, for the conversation. You and I both know, probably more than many, the extent process the Planning Commission is in Fayette County. I myself, having served on the City Council for a number of years and was involved in a number of zone change development plans, it is intense, and you as well. We've both been there, so I think the intent today was to be very sensitive to their role, which, as you know, is still going through that process with the neighborhoods, going through the Planning Commission development plans, and will go before the council still before the end of this year. And so we want to be mindful, as Johan said, to protect that process, whereby also taking advantage of the lessons learned. which are exactly what we've done today, and which is I applaud my colleagues for coming and presenting very specific, tangible policy recommendations that we can look at as taking what we can do better across the state to provide more housing across the spectrum or on the continuum. And that is really, the pathway is really important, and making sure there's no cogs. So I appreciate the sensitivity both in neighborhoods and also being mindful of how we can have really good state policy moving forward. And I think we've done that today, and I'm really appreciative of their willingness to share their experience. And the collaboration, I think, really is impeccable here, that they were willing in the room to say, okay, take my ego or my interests off the table. What can we do together? It shows we can do a lot. And I think that is a model that's certainly replicable across the state. So thank you. Thank you, Chair.
Thank you, Co-Chair. And just a couple of comments off the top of my head. I read a book. It was called Evicted. It studied the eviction process in Milwaukee. And it talked about how once a family is evicted, just one time, it's 3 generations. It's not that the kids are taught, well, this is, don't pay your bills and you'll be, like, it was one of those, I guess it's the inertia of poverty and the inertia of eviction carries through. And that's something that's really, really important for our families. One of the conversations that we have around our dinner table growing up was, how much should you spend on your gross monthly income per month on housing? 25%, 25%, 25%, 25%. Like, that's what we talked about at our house. And one of my stressors for, my background in education is that's the fiscal education that's got to be occurring. The concept of American dream, like, people say, oh, well, it might be your dream. We're talking about economic prosperity is tied to home ownership. My grandpa used to always say, brick and mortar, buy brick and mortar, brick and mortar, brick and mortar. And I've continued that. I continue that conversation with my sons. Around Thanksgiving dinner, we were talking about home ownership, and I was talking about how renting serves a purpose. It's temporary. And then my sister, who lived in San Diego, and my brother, who lived in Malibu, California, said, whoa. If I'm going to be home ownership, I'm going to have to save a down payment of 20%. Do you know what home ownership is like in California? It's particularly Southern California. I said, well, just rent a little bit longer. Like, renting is supposed to be temporary. And that's one of the lessons. Now, if it's not, and you've got the resources to pay for it, then that's fine. But when we talk about like a fiscal plan, when we talk about the American dream, it's home ownership. You want to buy that piece of land. So that's something that's very, very important that, when we talk about this, we talk about the possibility of this project, about the rental aspects of it. If I was the developer, the rental aspect would be temporary. It would be, if you're coming to live here, it's part of a plan. And your plan is, at some point, you're going to save up enough money for a down deposit or down payment on a house, and you're going to move into a place that's yours. And then you start reversing the trends of poverty, the inertia of poverty. You start reversing it with that. I think this is one of those keystone things, one of these keystone issues, and we're talking about it, and it's very complicated. It's a very complicated issue. There's the partnership that happens here. This project's not happening without a partnership. So I applaud you all. And Co-Chair, thank you for your work on this. This is really, really important. We need to take advantage of opportunities when the federal government provides them for us, because this is good for us. Maslow's hierarchy, shelter, first thing. One of the other things that we were taught, what's the first bill you pay every month? Your mortgage or your rent. Well, why? Everything else is negotiable after you can. If you can't protect your family, what can you do? Those are the lessons in that fiscal policy stuff that we need to be incorporating in our education and our conversations around the dinner table. Like, we're getting so far away from that. Culture today is debt, leverage debt, leverage debt, leverage debt. You have to have a jumping off point. My son is talking about these gentlemen who buy these $100 million properties. I said, well, they have to start with something somewhere. They have to save some money for a down payment somewhere. And that's what's really, really imperative about this. This whole concept is, and we're not so great about it as a society. It's the discipline behind saving. Look at the amount of money that the average American has in their savings account. I think the average American doesn't have any money in their savings account. But ask them what's the credit debt overall? I think it's pretty darn close to the national debt. We're talking trillions of dollars. So this is a big issue, and I'm going to wrap up with this. Thank you all for your work here. Hopefully this will be a model moving forward. One of the things about Lexington, and I've had conversations with other people in Lexington, one of the things we love and we hate is the urban service area discussion. We love it because of what it provides, but then when we have situations like this, where it's extremely challenging, and I work with the school system pretty closely, and we're always looking for pieces of land to build schools. So I'm right there with you with the urban service area because we have to build them inside New Circle Road. But anyway, thank you all for this. This is incredible work. Hopefully this is the first step for many, and I look forward to cheering you on along the way. Thank you all. And next up, we have Representative Emily Callaway from the 37th District in Louisville. Her discussion today will be on re-entry into the workforce. Ma'am, if you wouldn't mind introducing yourself.
Sure, I am Emily Callaway. I represent District 37, which is Jefferson and a little bit of Bullitt County. Thank you for inviting me today. This bill saw some good momentum last session. Ready to see it go through all the way this time. So I'll give you just a brief background and then lay it out so we know what we're talking about. So first of all, Kentucky licenses about 20% of its workforce. And in 2017, 2019 legislative sessions, there was a concerted effort to improve occupational licensing laws. And what that looked like was licensing portability for military veterans and their spouses, National Guard and Reserve members, direct relationship between the license and the crime that was committed, and individual consideration for each applicant. So we've made some strides and improvements in our laws, and we want to continue that momentum. And what that looks like is this is a starting point, and this bill has three main points. We addressed the application process. It requires boards and hiring authorities. So we're talking about licensing boards and state and local and public employers. They will be required to expeditiously process applications and disclose requirements up front to prospective applicants. And this allows potential applicants to receive a determination about whether their criminal history will automatically disqualify before investing in the training and the education that will be required for the licensure. And so this significantly reduces the risk assumed by the people who are interested in pursuing work in licensed fields but are uncertain whether their criminal history will ultimately result in a denial. Secondly, it promotes transparency. So the applicants are then able to make an informed decision. So when the board the board will be required to publish some of the things they'll be looking at: background checks, some that may be automatic disqualifiers because of the connection between the career and the crime. But all of this will be up front. And so before an individual goes through the process of education and any other pursuit to that career, they know what they're getting into. They know what they're going to be held accountable for. And then thirdly, what that actual process looks like. So this statute includes specific criteria that will be considered by hiring authorities and licensing boards when reviewing the application of a convicted felon. And this provides the applicant reasonable consideration while giving the license and hiring authorities exhaustive details surrounding an individual's conviction, rehabilitation, and ability to perform duties required by this job. So reviewing these details during the application process will greatly reduce the number of appeals for denials and will encourage employers to hire these ambitious applicants due to a more thorough vetting process during the application process. So it's great all around. Again, up front, they know what to expect. And then during the process, they are given due process. And then at the end, they'll know why, if they were denied, why they were denied, and how they can improve. So to kind of summarize, this will grant returning citizens opportunity to earn licensure without without so many barriers, and continue our efforts to reduce recidivism. We want to get people who want to work back in society, and let's get them working. And this will maintain and increase public safety, but it also gives citizens legitimate opportunity for well-established employment, not just a job. It does obviously boost our economy by allowing people back into our workforce. It gives consistency and impartiality, accountability on the board part, so that individuals will have that opportunity to present themselves, but also it maintains the integrity of the board, still being able to decide on the qualifications. So it does give them the discernment. And considering that Kentucky has approximately 95,000 unemployed residents right now, and 1 in 3 are ineligible due to criminal history, this would potentially put 32,000 people back to work. So this is very impactful. And again, with Kentucky licensing about 20% of its workforce, it's just something we need to consider. And I think this is a good starting point. And the more that I have these conversations regarding the bill, the more and more potential I see to make even more improvements while individuals are incarcerated, even begin programming and some of that counting once they get outside back into the workforce. So this is just, again, momentum. This is just continuing that momentum, and I'd be happy to entertain any questions.
Thank you. Senator Berg?
First of all, thank you very, very, very much. We need this type of legislation. The first bill I ever filed here after I got elected, our Kentucky State Police actually take inmates, train them to be licensed EMTs. They are allowed to work while they are incarcerated, but the day they get released, they have to rescind their license. And I'm like, wait a second, guys. We need a trained workforce. We can actually train these people. We can select them if we need to and train them while they are incarcerated and have ready jobs available. This is such a win, win, win. All I can say is thank you. Thank you.
Representative Kulkarni.
Thank you, Mr. Chair. Thank you very much for bringing this legislation. I had a question. When this was brought before, there were a couple, I think, of committee subs or different iterations. So I wanted to understand, is this draft that's going to be introduced, does it incorporate all of those?
Yeah, so the BR that I have drafted right now, I did get one additional page of recommendations for it that I'm going to go through. It will be minimal changes, but the tweaking was some of the public employment processes. They weren't even asking if individuals were felons or not, and so we didn't want to hinder any kind of application process, the turnaround and employment process. So we worked it to where what needs to apply for public employment applies to public employment locally. Or state employment, the section provide. So it was just kind of tweaking to make sure that we didn't undo any of the progress that we'd made in the past, and that we kept city-county employment or city-state employment considered as they are separate. But in legislation, the licensing board and hiring authority are coupled together. So we tried to maintain that integrity and then just work with the different entities to make sure that we were working with the program they had in place.
Great, thank you.
Ms. Smith-Willis.
Thank you very much for this presentation. It was very eye-opening. I personally have an older brother that served 10 years incarcerated, and one of the barriers that he faced was when he was in the halfway house. Is this only for jail programs currently at this moment, or is this going to be like across the board, prison, halfway houses, transitional places, in every component of the system itself?
Well, I'd like to see it get into all of that, but this would just be if they're applying for employment or occupational licensing. So wherever they find themselves, just that application process begins with them finding out if they are eligible for that career, if it's something that they're going to be able to pursue, and then they can go and pursue that from that. I would love to get involved in all of those areas, actually. But this is just strictly if they're applying for a specific job or licensure. Thank you for your question.
Co-Chair Bledsoe.
Thank you, Representative Callaway. And I've been supportive of your efforts and will continue to be so once it's filed. And Representative Brown, we've talked about making this committee make policy recommendations and consider things that would be useful. And this very much fit into that conversation, especially with Jubilee Jobs coming up next. We thought it was nice to have these as kind of partners, because what we want to do is create more access and opportunity, and this legislation fits that. And I applaud your efforts and look forward to supporting you.
Thank you. And I do want to say, as far as partnership, Goodwill has reached out. We were able to fund $6 million to Goodwill. They've reached out. They've got some great wraparound services and high school diploma programs. I mean, there's all kinds of things that they're working with the community to get people back into the workforce. And so it couples with them, and the Jubilee of Jobs I just was introduced. They're interested as well. I've been Kentucky Association of Manufacturers. They've reached out. I know Louisville is trying to incentivize employers to hire second chance citizens. So this does take us all working together, and I'm really excited to hear you all having these conversations because as you mentioned, I rarely meet somebody who doesn't know someone. It's usually a family member that's been affected by a criminal, some kind of criminal record. And so anything we can do to help them and get them back into society and stop creating that kind of stigma and second level society, I'm excited to do. So thank you all for this opportunity, for the discussions, and I'll be happy to work with you all, to tweak it any way you all see improvements going forward, and even working on additional bills to target some of the other concerns that have been brought up.
Thank you, Representative. Would love to see a continuation to returning the right to vote also, because I think that the research shows the more engaged previously incarcerated individuals are in society, the less likely they are to commit those crimes that would put them there in the first place. So I'm supportive 100%. Thank you. And our last presentation of the day, we've got Mason King, the CEO of Jubilee Jobs.
Thank you all so much. I really appreciate the opportunity from this esteemed body to be able to share a little bit. As Representative Timoney shared, my name is Mason King. I'm the CEO of Jubilee Jobs of Lexington, and I want to be considerate of the Commission's time, but I want to share some of the exciting work that we're doing and also add to the conversation about some of the challenges that we see with the individuals that we serve. So, in essence, Jubilee Jobs has a simple mission. We want to help anyone that is facing obstacles to employment with finding, obtaining, and maintaining dignified jobs. So we have a 7-step program where we help individuals develop the soft skills needed. How do you interview? And not just interviewing for dummies, right? Like, let's talk about how you navigate the fact that you have a felony on your record. And you don't want to get that door slammed in your face, but yet you also want to engage it honestly. We do conflict resolution workshops. We help them get resumes. Teach them how to use those resumes, right? A lot of my friends that I serve they're only ever been used to putting in an application. So being able to actually take a good resume and know how to employ it effectively, we work on that. But the bread and butter is that our jobs counselors work with individuals to help them find dignified employment. We're on track to help over 600 individuals in Central Kentucky find and obtain employment. And so far, we've helped those individuals in 2024 alone secure jobs at 203 different employers across Central Kentucky. So a lot of different people we're working with. We then provide some retention support on the back end to promote job longevity. I want to talk just for a moment about some of the auxiliary programs that really undergird who we are and what we're doing. One of the programs that I'm really excited about is our Second Chance Academy. So Mayor Gorton approached us a little over a year ago with the desire to have a reentry curriculum in our Fayette County Detention Center. And as of July 2023, we launched that program where we do programming while individuals are incarcerated at FCDC for 7 weeks. And then the real benefit is that we're able to provide a year of case management post-release to help those individuals reenter successfully. So, the course has some of the key components of soft skills development like we talked about. We also have some things that people don't typically expect for a workforce program, like parenting classes that are integrated in. Some people have challenged me and said, why a parenting class? Well, what's really cool is that studies have shown that programs that integrate family reunification as a component of their programming are 40% more effective than those that don't. I thought that was astounding, and it's certainly been true, right? Reality is we want to get well-paying jobs, but, I don't care how much you're making on the hour. Eventually, it might not be enough. And if you're only going to work because of that dollar on the hour, and you haven't been able to tie that vehicle of a good paying job to goals that really move your heart, like getting your kids back in your life or being able to buy that home one day, it might not be long. It might not be enough for long. So really been excited by some of the fruit. You can see here some of the first year outcomes, which we've been really proud of. We've had 101 participants, 96 of whom graduated. You can see down here, 37 of them were employed full-time by the end of year one. But what's really cool is that those numbers have already increased as you see. The 32 that were graduates but not yet released have now been coming out of the facility. The thing that really fires me up is that only 5 of these 96 graduates are not in compliant, meaning that they've dropped off our radar, they've gone back into jail. That's a big deal. And I'm not trying to toot our horn. I'm just saying something's working, and I'm really happy about it. One of the things that was a byproduct that we didn't really go out trying to achieve, but has been super encouraging, is that over a third of participants, as a direct result of their participation, have enrolled in drug and alcohol treatment post-release, which is a big deal considering the epidemic that we're faced. Another key program is our Innovate to Elevate program. We're partnered with a wonderful nonprofit called Black Male Working Academy under the leadership of Dr. Roz Akins and Commerce Lexington to be able to do programming that serves Fayette County youth with an emphasis on students of color. We do some really cool stuff, career exploration. We've got VR headsets. You see this young man that's exploring 40 different careers through this VR technology. We also have some really innovative stuff. We did a youth chamber trip down to Birmingham and was able to connect individuals with mentors. And so for the next 2 years, we're working to help expose young people in our community to 21st century jobs, and we've been really encouraged. 26, we have an upcoming workforce conference, so if you all want to come and participate, love to have you. And finally, the Resource Connection program. This is a critical program. What we do is we help assess individuals that come through our doors to understand the co-occurring issues they have, right? This isn't going to come as a surprise to anyone on this commission, but if you don't have a roof over your head or food in your belly or reliable child care or mental health services, you're probably not going to be successful getting a job, let alone keeping it for any length of time. And though we're a small nonprofit, we certainly don't have the ability to address all of those obstacles comprehensively. We do enjoy an incredible community network that we can leverage to help provide those warm handoffs that alleviate the challenges that affect employability. We've been doing a pilot over the last years. This dozen participants are representational of the 600 clients that we serve. And it's been incredible that we've seen almost half enroll in college, trade school, work-ready certifications as a result of participation. We've seen almost half that have received promotions and therefore pay raises as a result of participation. And again, I'm going to beat my drum on family reunification. A third that now have their kids back in their life at some level. It's awesome. Yeah. So we're hoping to see continued expansion. And this is why. And I certainly won't go through all of these for time's sake. But the reality is, my friends that are seeking employment have a litany of barriers that they are facing. 95% of our year one participants in the Second Chance Academy have substance use disorder, right? That is incredibly challenging. It also amplifies the fact that finding affordable housing is incredibly difficult. When I sat in our first class, I asked the 17 participants, how many of you know where you're going to sleep your first night out? One raised their hand. One. You know, this is a pressing issue for me right now, because when I showed up to work today, one of my clients that is a re-entering citizen was quite literally asleep in the floor of my resource room because she doesn't have a place to be able to stay right now because of limited housing, transitional housing, etc. You know, like, these are real people that are really struggling with this issue. And so, transportation, Lexington enjoys public transit in a way that many of my neighboring cities and counties don't. And yet those gaps still exist, right? Hey, I love it if I can get you into an intensive outpatient program. You can work on your SUD. But the challenge is it's time for you to get a job. Well, because of your classes, I need to get you a second or third shift job. What's that mean? Well, if you don't have a car, it means I can get you to work on LexTran, but I can't get you home. Or I can't get you to work to begin with, but if you somehow figure out how to get there, here's a bus pass to be able to get home, right? Like, there is still prolific gaps that are insurmountable for a lot of my friends that I serve. I'll just hit a couple of these last things before I transition to a few comments. We see breakdowns of healthy support system. That's why mentorship programs and helping to provide support for case management is really important, because a lot of my friends lack the social capital in order to be able to re-enter successfully, right? Let me tell you who I see succeed when they come out of the detention center. Those that take us up on our offer, and within the first 24 hours of release, they're calling us to say, all right, I'm ready to come in to finish this process, versus individuals that call that friend or that co-parent or what have you, and then drop off the radar. So what's a few things that can be done? Certainly don't pretend to be a policy expert, but I can say that we've seen the need. And some things that would be really helpful is to find some type of way to increase transitional housing. We're fortunate that for us, there are sober livings that people can get into when they have SUD. Many of our clients, 70% have some level of addiction that they're battling. But such as the individual that's in my office right now, she doesn't have substance use disorder. Well, there are no real transitional housing programs right now in Lexington that have open beds. So that creates a problem. So finding some ways to incentivize that, it would be huge. There's been good strides with this. So I want to commend your all's work with helping with work-ready documents. But certainly we still have individuals every single day that have just been released that don't have those basic documents. And you all already know, if you don't have an ID or social security card, you're not going to be verifying your I-9. So what happens? You can't get a job, that delays, and that snowball gets bigger very quickly. So continuing that work would be critical. I would love to see greater paratransit infrastructure emerge. Again, I need to figure out how to address this second shift, third shift gap that exists in my city, let alone, of course, my friends that serve rural counties that don't have anything to speak of. But finding a way to address the transportation barrier would be important. And then listen, seeing some way to help expand funding for organizations and entities that can build capacity to provide case management to individuals. Gosh, that is why this program at FCDC is succeeding. I'm proud of the curriculum. I believe that it can go toe-to-toe with just about any other curriculum in our state. However, it's the fact that I've got people that, because of this case management funding, have the capacity to pick up their cell phone on a Saturday and be like, oh, you're stranded on the side of the highway? No worries, we're coming to get you. You're struggling to find affordable housing. Well, let's get in the mud together and see what we can figure out. It makes a difference. So thank you all, seriously, thank you so much for the opportunity to just take a few minutes of your time, and I certainly defer to you for any questions, sir.
Thank you. That's an excellent presentation. I really like your energy.
Thanks.
It's very reassuring, very optimistic. Do we have any questions? Senator Berg? And Representative Kulkarni.
Thank you, sir. Again, wonderful presentation. I actually, if it's okay, Mr. Chairman, have two questions.
Start with the second one.
I will start with the second one. Do you feel that there is adequate substance abuse therapy happening in the prisons before these people are being discharged? Are they coming out with an understanding of what clean, sober living is going to require of them, or are they coming out just, can't wait until they get back on the streets? I mean, what are we doing an adequate job while they're incarcerated? First question. Second question, where does your funding come from?
Thanks for both of those questions, Senator Berg. So the first question, I certainly don't want to speak too broadly because most of my experience has been within the Central Kentucky community, namely FCDC, where there is programming, for example, from the Hope Center that provides that recovery support while individuals are incarcerated. That said, only those that are in the programming pod are eligible for that kind of service. There's also certain requirements that make it challenging depending on someone's length of stay and what kind of services they can access. The reality is we've seen, unfortunately, a lot of our reentering citizens, because they lack some of these other critical resources, they find themselves back in the same cycle, which is not, that's surprising. I think most of us go back to what we're used to. We go back to the things that comfort us, whether those things are good or not, right? The reality is that that's easy for us to do. So I certainly would love to see continued expansion of that recovery support provided for individuals who are incarcerated, because I think, listen, if I can't help you address that root health concern, man, I could work till I'm blue in the face. I'm not going to be successful in getting you long-term dignified employment. So I hope that answers the first question. The second question, we receive funding from the LFUCG to be able to, for example, provide the Second Chance Academy in the detention center. We also run the city's Work Lexington group. We're the nonprofit that leads point of the 8-body collaborative of workforce efforts that are happening within Central Kentucky. And then the rest of our funding comes from private donors and foundational support. Yes, ma'am.
Representative Kulkarni.
Thank you. Senator Berg asked one of my questions, which was, how are you funded? My second question was, what are your biggest barriers as an organization? So if you're a nonprofit and you're funded through foundations and grants and some local government funding, is that a barrier, or what are some challenges that you faced in the years that you've been operating, which I'm also curious about how long you've been doing this?
Thanks, Representative. Yes. So we started in 2009, so this is our 15th year. However, we are modeled off after a program by the same name, Jubilee Jobs, in Washington, D.C., which has been working for over 50 years in that community. So to your question, yeah, funding, of course, is always limited when you're asking a nonprofit executive. I'm never going to say, no, I've got too much funding, Representative. But really, what would I like to employ funding for? It's to ultimately increase staff, right? The reality is being able to see greater unrestricted funding or funding that allows the expansion of that case management team. Because the reality is, why is there so few of it? Because it's a lot of work. And it takes a lot of time and a lot of energy to do it effectively, because simply handing someone a handout and saying, here's a list of resources for you, it might do something, but goodness, it's not nearly enough, right? But being able to actually walk with someone, and when you say, I'll be there when you call me, and actually be there when they call you, it matters. And so my hope is to see increased funding so that, again, we can provide enhanced and expanded case management so that we can really support individuals. What I've loved about the resource program, a couple of our people that have participated have now dropped off, not because they've gone back to jail, not because they've lost their job, but because they're now self-sufficient, which, like you saw on the opening slide, is our tagline: work for sustenance, dignity, hope. It is that picture of self-sufficiency that says, when you don't call me anymore, and it's for those reasons, I love it, you know? So anyway, thanks for the question. I hope that answers your question. Yeah.
Any further questions? If there are none, thank you very much, sir.
Thank
It was
you.
an excellent presentation. Our next meeting is October 22nd. We'll be discussing maternal health disparities. And if there are no other discussions, we are adjourned.